When I was a little kid, my mom used to take me to McDonald's every once in a while for like an after school snack, and I'd be sitting there eating my Big Mac, looking at my Happy Meal toy, eating my nuggets, going like, "Oh, I love McDonald's. I love McDonald's." And my mom said to me, if you love McDonald's so much, why don't you own McDonald's? And I was like, "Oh, I can own McDonald's?" This was early 90s. Smartphones didn't exist. The internet didn't exist. I didn't know what stocks were. I didn't know what investing was. But my mom used my love of McDonald's to teach me about the stock market. And she said, well, if you love something so much, you might consider investing in it. So pre-smartphones, pre all that stuff, we got on the phone, called our stockbroker, her stockbroker, and she got me on the path very young as someone who was really interested about investing. And from that moment on, I saw every product that I had, like this, as a potential investment. Well, I love it. I drink it. It's delicious. Maybe I should invest in it. I love Big Macs. Maybe I should invest in it. When WWE, I'm a lifelong pro wrestling fan. In fact, this is me when I was 18 years old. I wanted to be a pro wrestler, if you don't know. First day of class right here, and I also, first day of class, broke my back. Different story. But I'm a lifelong pro wrestling fan, and when WWF, now WWE, went public, I thought, oh my God, I got to invest. I got to own what I love. Now, this doesn't always work. Owning what you love, investing in what you love isn't always a great investment, but changing the way you think and saying like, hey, I love this product, maybe it's worth investing in, is definitely a great first step when it comes to you buying and investing in individual stocks. I think everyone across the board should just invest in a broad market S&P 500 index fund, something like one of these or like the Schwab High Dividend Index Fund. And as you progress as an investor, as your journey as an investor expands, then so too can the kinds of investments you're putting in your portfolio. But most people aren't going to be the kind of investors who like to buy individual stocks. Maybe they come to it on a hot tip like AMC, GameStop, Kodak, and they go, oh, investing is kind of fun. Or like most people, they put their money into something extremely speculative. They lose everything, and then they feel like investing isn't for them. Although what they were doing wasn't really investing. What they were doing was gambling, rolling the dice on a hugely speculative play that worked for some, didn't work for others. And it discourages them from investing because they confuse or conflate gambling with investing, and they go, oh, stock market's not for me. I tried it. I lost everything. So most people should come to this world of investing as just dumping as much as they can into something relatively safe, relatively boring, that will make them a millionaire in retirement if they do it right, if they live below their means, don't buy flashy stuff, fancy cars, designer clothes, so they have more money to invest, which means they can retire a little earlier. So I'll run the numbers right here on the screen to show you what it would look like if you bought an S&P 500 index fund, only an S&P 500 index fund, and contributed, say, $100 a month for 30 years, and then $200 a month for 30 years, and then $500 a month. I know not everyone has that, but whatever this end number is, whether it's a couple 100,000 in retirement or $1 million in retirement, is gonna be money you're glad you have when you get to retirement. And it also isn't an either or, right? It isn't like, oh, I don't want to invest anything because life is for the living and I want to use my money and buy the things I want, so I'm not going to invest. And it also isn't, I'm going to punish myself and live so far below my means that I have no enjoyment and no love of living so I can have this money in retirement when I might be too old to enjoy it, right? It's a combination. It's not an either or, like so many people on social media make it out to be, especially in my comments where they go, oh, I want the money now. It can be both. Once you get that foundation of an S&P 500 index fund, if you later on decide like, hey, investing is fun, I want to own some individual stocks, one of the things I notice so many people say to me in my comments are, I don't know what stocks to buy. I don't know any companies. But the reality is, you know more than you think. For example, I love McDonald's. I'm going to go there for lunch right now, and I'm going to take my 1985 Bronco there to get it out for a little Sunday drive. So why don't you come with me? And when I come home after lunch, we'll go over the numbers and we'll see whether McDonald's is a company you might consider investing in or not. Let's go. All right, I have convinced Sarah, that is the girlfriend, to come with me. I've got my winter coat on because it's cold. She's never had a Big Mac ever. Let's go, I'm really excited. Are you excited about your Big Mac?
I am, my first ever.
Here we go. None for you. Oh, so the question on everyone's mind is, should we invest in McDonald's stock or not? Now you can see on the screen right over here to the other side of me, we've got some facts about this company here. You can see right at the top that McDonald's is $269 for one share. That's expensive, but they've got a market cap of almost $200 billion, which means they're a large cap blue chip stock. McDonald's isn't really the sort of company that's like a fun and exciting growth stock. They're not Tesla. They're not gonna smash through earnings quarter after earnings quarter with blowout record sales. We've never sold so many. I mean, Tesla just had a pretty bad quarter. They had a miss. But you know what I mean. They're not some like fun growth stock that's growing and growing and growing. McDonald's is the kind of company you can put in your portfolio, your kids' portfolio, and just reinvest the dividend. And speaking of, their dividend is $6.08. It's around 2.3%. It's not the highest dividend you might find at the end of this video, that there are more affordable stocks with higher dividends that are better for you, but this is a video about McDonald's. Their price to earnings ratio is 33 times. Price to earnings just compares the price of the stock to the company's earnings. There's a whole bunch of math that goes into this. It's pretty boring. I failed math through high school, so I have videos on it here on my channel, but we're gonna gloss over that. If you wanna learn more, I can put them in the comments below. Essentially, the price to earnings ratio tells you whether a stock is undervalued or overvalued. The higher the multiple is, the more overvalued the stock is. Sometimes this is really bad, and it means that the stock is overvalued. And if they have a miss like Tesla, you can see the company lose a massive amount of value. On the other hand, it tells Wall Street and its investors that people are willing to pay a little bit more for this company because they believe in the long-term goals. A lower price to earnings ratio is also a good sign because it says that there's potential there, that it's trading at a lower multiple than, say, their competitors, which means you might have found a value stock, something that's beaten up way down when compared to their sector or the markets overall. Now you can see here that McDonald's, while it has a relatively low price to earnings ratio at 33 times, it's higher than the industry average at 13 times, which means compared to other fast casual fast food restaurants, McDonald's is a little overvalued. But I'm not particularly worried about this, especially heading into a likely recession, or we might come to find out that we're already in one. Usually when it comes to recessions, you know you're in one, or you find out about it halfway through or after the fact. They go, oh, this was a recession. So it could turn out that we're in one right now, and when people have to buckle up on their spending and control what they're buying, they look for cheaper options. I mean, consider that meal from McDonald's. That Big Mac was $12 for a large. When I was a kid, a Big Mac meal was $5.99, so it's more than doubled in price. But when you consider what you're getting compared to other fast casual restaurants, on the one hand, it's probably not as good for you as Chipotle. On the other hand, it's probably calorically pretty similar, but you know, with all the added ingredients and stuff that you get at McDonald's, you don't have at Chipotle. Anyway, what I got for my $12 was a drink, a large drink, large fries, and a Big Mac. And if I were to go to Chipotle, I would get for around $13 or $14, one burrito with guac. If I wanted a drink and chips, it would be almost 20 bucks. So big picture, yes, the prices have gone up at McDonald's, but they're still relatively affordable compared to your other options. Now, you can see here on the screen to the left of me or to the right of me, depending on how I edit this video later, that McDonald's revenue in 2018 was $21 billion, and now it's $23 billion. So it's gone up a little, but again, McDonald's isn't a super high growth company. Their net income has also gone from 5.9 billion to 7.5 billion, which is good. Their total assets have increased from 32 billion to 53 billion in just a few short years. That's also good. Their debt has gone from 31 billion to 48 billion, which obviously isn't great, but again, it's McDonald's. I don't think they're going to have a hard time paying back their debt. And also, their long-term debt is 48 billion and their market cap is 197 billion. So it's not like their debt is more than the company is worth. Then you would be in real trouble. Their free cash flow has gone up as well to 7.1 billion from 4.2 billion. So they've got more money. Here's the interesting thing about McDonald's. Now, you can see they're up 193% in the last decade, but what's really interesting is that they have 36,000 locations worldwide. And the thing you might not know about Mickey D's, and I'll put it on the screen, they own a lot of real estate. So people always look at McDonald's and they go, oh, well, it's drinks, it's burgers, it's fries. That's how they make their money. But they actually make a lot of their money from real estate, because McDonald's owns the locations that the franchisees then have to rent from McDonald's. So not only does McDonald's get that revenue stream coming in from burgers and fries, but they also get a monthly check from every tenant that they have, basically, who's renting these locations. So anytime I do a video on TikTok and I say, oh, McDonald's revenue, someone inevitably will go, McDonald's is a real estate company. They're not a food restaurant. All right, whatever. You get what I'm saying. The benefit here of McDonald's is they have the revenue coming in from the food and the real estate. It's like someone who works a job but also has a couple income producing properties. So they have that cushion of additional income. Now, I believe all of these numbers will continue to grow, like I said, as we're heading into a recession and people are constraining on their spending and looking for cheaper options to eat. There's no dollar menu anymore, right? It's now the $3 menu. But it's still relatively affordable. Now, McDonald's is also heading very close to dividend king territory. Currently, they're a dividend aristocrat, which means that they've raised their dividend consistently every year for 25 years or more. And they're at year 46 right now, which means in 4 years, they'll cross over to dividend king territory, which is pretty big deal. Again, their dividend's not great percentage-wise. Again, as I said, you might find like, hey, Verizon, Ford, these are companies that are much more affordable from a price point, right? $269 a share versus like in the 30s or in the low teens for Ford. The other interesting thing is McDonald's has a dividend payout ratio of 56%. Now, if you don't know what a payout ratio that's okay. I'll put a link to a video I did on TikTok in the comments below that will go into it. But the dividend payout ratio is how much of the earnings the company is paying out through dividends. And right now, McDonald's is sitting at around 56%, which means that they have more room to grow that dividend over the years. They're not giving 70 or 80% of their income. The last thing that I want to talk about, I've got my dry erase board behind me, so I might move the phone just a little bit so I can see it, is what it would cost you as an investor to make $1,000 a year from McDonald's dividend. Now, you would have to own 164 shares, and at $269 a share, it would cost you around $44,000 to just make $1,000 a year from the dividend. So you might find, like we talked about a second ago, that this isn't really worth it for you, that McDonald's might not be right for your portfolio. On the other hand, it's still a stock that, in addition to the measly 2% dividend, is up 193% in a decade. And that's pretty good. So if you thought this video was helpful, hit the follow, hit the like, hit the subscribe. You know what to do. Thanks for watching and have a good day.